Okay, to finish off the conversation on income statement, just some common phrases. Revenue equals sales. We may see it as net revenue, net sales, gross revenue, gross sales on our income statement. Just depends on how your accountant lays it out. Um, NIAT, which is net income after taxes, or earnings after taxes, or net profit, or as you may see in some TV shows, earnings available to shareholders, which hints at the fact that the shareholders actually own what's left over at the end of an accounting period as far as the net profits. Operating profit and earnings before interest and taxes are taken out, also same thing. And one of the dirty things about things like this is you really should memorize this for future use. Okay, common limitations to the income statements. It records past events, doesn't look or address about the viability or the changes in the company's market down the road. Um, Accountants and managers have some flexibility in reporting transactions and income. A few years ago, we saw something with Nortel Networks where they started reporting earnings that weren't really in the accounting sense. The money wasn't going to actually come in the door for another year or so, but uh, managers and that sort of thing got paid bonuses based on profits. So how do you increase your profits? Well, you increase your earnings without really increasing the expenses. So that led to some downfall events of Nortel. And even though the government lays out how things are expensed in terms of something called capital cost allowance, some companies in their non-government submitted financial statements will calculate asset values and inventory values and for that matter amortization in a slightly different way. So these are some things you need to be aware of, or that could happen if you're looking at from the outside in, trying to decide some strategy regarding the company investment. So assuming at the end of the year we have some profits, some earnings, net earnings, what happens to them? Well, a few things can happen to them. One can keep the company so we can save up to buy more equipment or invest in something to increase our sales. Okay, and as we do save up to buy equipment or land or building or something like that, that would be an investing activities. The shareholders actually, in a sense, are not taking the money out of the company; they're leaving it in the company, and by doing that, they're actually reinvesting in the company. If you're going to buy inventory or something like that, supplies to keep the company running, then that's an operating activity. And in both cases, the earnings are kept by the company. Okay, so this means the earnings are retained or the profits are kept. And on the balance sheet, we see this in the equity section under retained earnings. So if the company keeps the profits in the company, the retained earnings go up. Okay, and of course, when the retained earnings go up, the equity of the company goes up. The alternative to that is the profits can be given back to the owners. And the mechanism for this is actually a legal mechanism, and it's called a dividend. So dividends are given back to the company, or excuse me, given back to the owners, and then they're free to spend that on whatever things, maybe another company or groceries, whatever the case may be. Okay, so if dividends are declared and are paid to the shareholder, um, it's a return on their investment. If the balance in the retained earnings account or line on the equity part of the balance sheet is negative, we cannot pay out dividends. Okay. And when you pay out dividends, the company's equity or the owner's equity, same thing basically, is reduced. So the equity section of the balance sheet goes down, and correspondingly, of course, the cash balance goes down. So the balance sheet balances. In this case, when we declare dividends, earnings are not retained. Okay. And by the way, retained earnings can be negative if a company experiences a bunch of losses. Okay, so when the equity decreases, retained earnings goes down, and losses do that. Okay, just a quick note on dividends. The board of directors will declare the dividends. In a small company where there's only one or two people um, running the company or owners, and they're on the board of directors, then they can just sit down and say, okay, next week we have enough money kicking around, no plans to reinvestment. Let's declare ourselves some dividends. It can be that simple. Something you do over dinner, a case of beer, whatever the case may be. Um, that's how informal some of these things can be, but they still have to. This sort of thing, legally speaking, is a motion and has to go into the company records. And also, a dividends requires a generation of a T5. When you're employed by a company and you get a salary, you get a T4. When you get dividends, you get something called T5. But that's the down the road as far as we're concerned. Dividends decrease uh, equity. Okay, Re- earnings are not retained; they're given to the shareholders.